Welcome to yCITIES Inside the Mind of an Investor series. yCITIES cultivates an intergenerational innovation ecosystem for middle schoolers and beyond, supporting a diverse pipeline of tomorrow's founders and investors. Angel investors are a vital part of the startup community, and while there are plenty of resources about how to pitch or how the process works, it can still seem like a black box as to why an investor chooses to invest or not only to the founders, but also to peer investors. So we decided that we wanted to have many conversations with many different investors and to focus on one investor at a time. Every interview is anchored by the same 4 questions, but each conversation is shaped through follow-up questions influenced from the different lenses of our panel of hosts. So today I'm super excited to introduce our guest investor. Welcome, Melissa.
So thank you for joining us today. It's really an honor to have you here. We always like to start off with, if you could tell us a little bit about yourself, with yourself leading to kind of what's your investment thesis, how have you kind of landed on that, a little bit about your propensity for risk and the things that you look at in general, and kind of just give us a good understanding of who Melissa is.
I got it. Well, thank you. And thank you for having me. And I think it's so important to have different investors to prove the point that there's no monolith in investing. I think it's one of the great mythologies of startup culture is that there's one kind of investor and one pathway to capital, and it's total farce. So I think it's amazing to put different investors against each other to see where they overlap and where they don't. I am too old to have been a professional investor my whole life. That's a very modern phenomena that kids go to college to become investors. I started out in biological life sciences. My background's in science and technical communications. Then I did a bunch of other crap. And then I found my way to early stage investing back in like 2010. I started out as an early stage equity investor. I ran a seed portfolio with my partner. We did about 90 companies through that seed portfolio. But at the conclusion of that process, I found myself really frustrated by the constraints of the equity only model and this myopic obsession with exits as the only way to win. It was creating a lot of bad behaviors, a ton of barriers to entry, and it was really limiting the scope of founders and companies that I could personally invest into and work with. So in 2016, my partner and I created RevUp Capital, which was one of the first revenue-based equity alternative funds for early stage companies in the world. And we took some chances, but we got lucky and it worked. So fast forward to today, we're on our 6th fund. And that's pretty much my full-time job. I run RevUp Capital and lead selection and work with our portfolio. And we invest into revenue-driven, customer-centric companies that are in the market and selling, but they probably only have between 500,000 and maybe $2 million in revenue. And we're looking for companies that we think can become $20 million companies in 3 to 5 years. And then maybe beyond that, about a third of our companies go on to raise other kinds of capital and look to be venture scale. But that's my sweet spot. I don't know if you know this, but about 4% of all companies get to $1 million in revenue, only 0.4 get to 10. And that struggle is my struggle, and that's where I like to play. In terms of risk tolerance, one of the things that's interesting is having been an equity investor and then switching to revenue, the whole framework for what you're looking for does shift and change. So I've had the experience to invest in over 140 companies now. So I think about risk in a really holistic way because I've seen everything go wrong. I've seen products not come to fruition. I've seen markets fall apart. I've seen recessions come. I've seen founders burn out. I've seen teams break up. I've seen people get divorced. And then I've seen just kind of like happen. When I think about risk, I think a lot about capacity. And does a company have the ability to build the capacity it needs to weather the storms that are ahead? And so I think a lot about operating expertise and capacity. Those are the things that I'm attracted to overall. I would say we're medium risk.
Got it. It feels like you've done this before. Like that was so fluid.
It's possible. It's possible that I may. Yeah, it's possible that for a very long time there were no women investors. There were no women investors for a really long time. So I was the token chick on every panel, and so I have had a lot of opportunity to practice being comfortable in front of a camera. Yeah.
Yeah. Real quick before we move on to the other questions, can we just double down on capacity?
Yeah.
Are you referring, because there's probably a lot of different areas where you'd say like they need to have the capacity. Can you expound on that a little bit?
Yeah, that's kind of like one of those like 25-cent words that only means something in like your own mind. but no one wants to pretend like it's meaningless, right? Because it's such a pretty word, like capacity, but really, what does that mean? When I think about capacity, I think about when you're building a company, you have to be able to add stuff in the broadest sense. And so capacity is that sort of that engine and that like fuel that allows you to add stuff. So do you have the ability to attract talent? Like, you'd be surprised how many people, even if they're like talented, they can't get other talented people to work for them because they just don't know how to put the right vibe out. Like, so do you have the capacity to attract talent? Do you have the capacity to grow? Is there some, do you have access to the resources that you're going to need to get there? And do you, at your core, you're not going to have it when I meet you, but do I believe that you know how to, do you know how to think about what you need? And then do I believe that you have at least a plausible pathway to getting some of those things as you're traveling through time and space?
Yeah, awesome. Thank you. Thank you for that.
So I have so many questions. I'm trying to filter through like which one I want to ask first. You know, you're probably approached by founders all the time, and you have finite, amount of hours in a day, and you have a life and kids and other things. So one of the things that has been a common theme as far as what makes an investor when they're kind of scanning like a pitch deck to decide whether or not they want to have an initial coffee, or if they're part of a screening committee, should this be screened through? So I was wondering if you could address that piece first.
Well, so I think there's parts of a pitch that are going to be very particular to the investor that you're pitching. Sure. And that's your job as the founder to figure out what kind of company are you? Are you capital intensive? Are you capital efficient? Are you going to have an early acquisition or a long slog? And that's the part where investors will just pattern match. And there's no wrong match. It's just investors have a thesis and they have a pattern. But I do think, in having spent time in all the different models and working with other funds and sitting on diligence committees, I have a bias towards the parts of a story that I think are really important to get right. And this is counsel that I give to even the earliest, to really young founders, and then also to very mature founders. I find that they all come needing this kind of reminder. I think there are 3 questions your deck needs to nail straight away. And it's got to be why now, why this, and why you. I think people get the why this, like the why your product, and they get the why you. People really phone in the why now. So timing is one of the most peculiar but most important drivers of whether or not a company is successful. And I didn't make this up. There's actually a old TED talk that's still one of the best about looking at 100 companies and how timing, not how much money they made, but timing were they at the right place at the right time in order to have this venture be successful. And I think for so many companies, putting yourself in the position to be at the right place at the right time and really owning what's happening around you in your industry, in the ecosystem that's leaning in towards your business. Or is it the right time because the buying behaviors are there? Is it the right time because there's a convergence of technologies and you're taking advantage of that? I think a lot of founders struggle to talk about timing because it's sort of external to you. You don't control it. We want to talk about the things we control, but I think some of the things that I always want to go deeper on are ones that just figure out in a really concise and clear way. Give me that sense of why now, why this, and why you. And for me, that's if you do pretty good on those things, I will want to talk to you more. And I'm not going to study your financial slide. Yes, I'm a revenue investor. I look at your traction slide. If you're pre-market, then I might not want to meet with you as an investment prospect. I might just want to meet to give you some advice. But beyond that practical stuff that matches to the fund thesis, I'm really looking for that why now, why this, and why you.
And kind of those 3 things, do you weight them evenly? Is there one that you look at more, or which one that you look at first?
That's a great question. To me, they need to work together, but I will tell you that some really great teams with some really great ideas have definitely been dead on arrival because the time was wrong. It's hard to not, once you've seen it, you can't unsee it. So there is really, I think, a very important part of a company's narrative to really articulate why is the timing right? Why is the market ready? So I don't know if I could say confidently to you today that I privilege that always, but I think you could have a great product, a great service, and a really good team. But if there's something where I'm suspicious about your market timing, like too early, too late, that might be a barrier to my being really enthusiastic about working with you. But I reserve the right to change my mind about that upon reflection.
And how do you determine that initial sort of reaction?
What was that? Sorry.
How do you determine that initial reaction of whether or not the timing's right or the product's right for that market, for that timing, and that the founder can deliver the product when needed? I know you're talking a little bit about revenue-based investing and sort of.
Well, I mean, just even putting aside my own fund, if let's say I'm working with another fund and doing diligence or working on selection with them, I mean, I think maturity helps, right? So I've been around for a while. I've done 130 companies. To do 130 companies, I've seen, I don't know how many pitches. Like, it sounds absurd when I say it. Like, if I say I've seen 10,000 pitches, it sounds ridiculous, right? But if you think about every startup competition, every demo day, like, and then all of what it took me to find the 140 companies, like, it turns out, yeah, I've seen a lot of pitches. So
I feel like you've probably seen more than 10,000. Like,
a lot, yeah. I don't
sounded
know.
low.
Yes. Sometimes sometimes I look at dozens of things a day. It depends on the day. I mean, I think a lot of, this is not necessarily good news. A lot of what happens in a dialogue with an investor is sort of gut pattern matching, which is not, so that's like, it's not a meritocracy. Oftentimes there's a lot of bias that can come into that. If you come to me through a warm introduction, I'm going to look at your deck with a different gaze than if it came in, in a cold email. And I've had to work really hard to open myself up to those subtle biases that affect our decision making. So I think diligence is a very personal process. And because I have a small fund, I only make 12 investments a year, maybe 15. And my partner and I make all of the decisions. We don't have an investment committee. I don't have to convince anybody else. So for me, I have a strategy for that, but it is very personal. And it's there are a lot of lenses that come into play. Like, who do we have in common? Have I invested in a company like yours, and has it been successful or has it failed, right? So what's my historical bias? Like, what baggage am I carrying? Like, investors have like Louis Vuitton level baggage when it comes to, coming to the party with a lot of past experience, right? So, I think my process is to try to enter into a dialogue where I try to balance my gut reactions, which can sometimes be not good, with the opportunity to listen a little bit, but I don't have all day. So if you're not good, your story isn't good, and you don't know how to talk to me in a way that's going to keep me interested, then I'm probably going to swipe and move on to the next one.
You mentioned pattern matching a few times. And so in essence, pattern matching is kind of where you match your skills and interests with pain points and things of that sort, so that you become smart money, right? So that you're useful as an investor. But I also know that, like, you're a champion for, diversifying pain points and supporting underrepresented underrepresented founders and things of that sort. How do you balance that? Because it might be, a pain point where it's not something that you're familiar with, and how do you balance the investor kind of, strategic smart money thing with a lot of where your heart is?
Yeah. I think the pattern matching is a little easier for me because my fund can tolerate a relatively broad spectrum of outcomes. When I was working exclusively in equity, the only outcome I could tolerate was to sell the company. That was it. You had to have a liquidation event. That was it. The fund that I have now is able to generate returns for our investors through a number of outcomes. As long as the company grows, I can find a successful outcome there. So my pattern is broader by definition, right? And that's not good or bad. I have colleagues who are in hard tech. That's what they do. They're swing for the fences, change the world. Most companies fail, one wins and blows up everything, right? Like, it's a good pattern. It's just not my pattern. So when I picked this pattern, I moved to revenue-based investing because I wanted to have a broader pattern, because we were using the exit-only excuse as a way to build a lot of barriers to entry for companies. It was very easy to look at a team and say, they're not venture scale, and not have to unpack that, right? Because the vast majority of companies actually aren't venture scale, as it turns out. It's a relatively narrow niche of all of the companies in the world that you could possibly invest into. So my pattern is pretty broad. I'm really straightforward about my interest in the founders that I want to work with. You know, life is short. This is a small fund. I'm accountable only to my team and to my investors. And they know that my priority is investing into founders who are building their businesses outside networks of privilege. And I don't front about that. That doesn't mean that I don't have men in my portfolio, that I don't have white men, white women. We have a little bit of everything, but the vast majority of our founders are building their businesses outside of network of privilege. Not all, but the vast majority. And it just turns out that there's just a lot of those people in the world building good companies. So it's not particularly difficult in the sense that the patterns naturally align. My job is to just do the legwork to make sure that I'm in the right places and spaces to find those really excellent companies and make sure that I'm the one that gets to invest into them.
It sounds like you have a much more flexible, broad limitation to where you put your investments. And I'd love to talk to you a little bit more about, and for you to discuss a little bit more about, you know, how do you decide what's the difference between a good business and a good investment? Because it sounds like with a revenue-based versus equity-based investment, you have a little bit less limitation.
We look for companies that we think can become $20, $30 million companies in a relatively tight time frame. That doesn't mean that they won't become $300 million companies. It's just, I don't need to count on that terminus for it to be a successful investment. So I'm looking at a company and I'm thinking, between now and then, do I believe this company can become a $20, $30 million company? They may want to become a $300 million company, and I just need to understand their vision and how that impacts the sort of next leg of the journey. So, when I'm thinking about that, I'm looking at, does the company have the right skills in order to navigate that? I think what makes a company a good investment for me, and for any investor, is, does the pattern match? Like, so do I expect the return from this investment to be commensurate with what I've promised my investors? Like, at the end of the day, that's just how fund managers have to operate. I told my investors I was going to do X, Y, and Z, and I told them it was going to result in this. Does this match that pattern? Whether or not I want to invest has some other variables. Like, do I like you? Do I want to spend time working with you? My time, my money, my energy is finite. And if I give it to you, it means I can't give it to someone else, right? Also, am I going to be good for you? Am I going to hurt you? Am I going to be a good member of your team? Am I going to be an asset to your journey? Or is it not going to be good? So I think there's the pattern matching, and then there's the personal side, which is just, is this going to be a good fit? And if it's not an enthusiastic fit in the beginning, that's pretty bad, because usually the road's pretty bumpy. And if you don't start off really trusting and liking each other, probably not going to end up trusting or liking each other after you have to go through difficult iterations of the business, right? So just trying to find the right alignment of economic pattern matching with interpersonal pattern matching. And most investors that I know operate with that kind of lens.
So what does it take in those 3 to 5 years to go 10x, to go from 2 million to 20 million? What are the most important things in those 3 to 5 years that a founder should be focusing on?
I think the hardest thing is going from people to process. A lot of what gets you to your first million is actually, not only does it not get you to 10, it can keep you from getting to 10. So in the beginning, you're walking around in the woods, you're gathering mushrooms, you're trying all kinds of different things. You're letting people experiment with their roles and responsibilities, and you're letting a lot of key parts of the business be driven by personality and the grit behind that personality. And that's pretty powerful. And it's hard to get going without that kind of dynamism. When you want to go from 1 million to 10, you need to have repeatable processes that are not tied strictly to the personality of the people doing those jobs, because people come and go. So you need to have processes and positions that are marginally stable, right? And then the other thing that you typically have to do is you have to grow your market-facing activity. So whatever market-facing activity got you to 1 million probably doesn't alone get you to 10. So you have to layer on other market-facing activity, whether it's expanding your customer segment. It could be so many things, and a combination of all those things. And that can be really hard to do when you're at the lower end of that spectrum, because probably you don't have a lot of bandwidth. you don't have a lot of resources, you're not flush with cash. So you have to make this whole people to process transition and really become more sophisticated on the market facing side in a very resource constrained environment. And that's really tricky. And that's a big barrier for a lot of companies.
So that second part, kind of expanding the market facing activities for example, for a software company, would that just be like a lot of investment into product, or how would that come about?
Typically the opposite, right? I think the temptation is always to spend more money on products and and I think many companies underestimate what it costs to go to market, and they tend to overinvest in product and overbuild product. It's really common. And I think it's because where we feel comfortable, right? It's your product. It's like you see it as your heart and your soul. But usually where the growth opportunities, it's not to say that the product doesn't have to evolve or that you don't need to continue to make the product better in ways to please and satisfy a broader spectrum of customers, but that's usually not the most important thing. So typically what you have to start doing is have a repeatable and reliable way to experiment with your market facing activities to figure out, let's say you're doing strategy A and strategy A is working really well. Well, you better keep doing that because that's what's keeping the lights on. But you probably have to expand into something that is pretty different than that. And it could be around how you acquire your customers. It could be what you ask your customers to do. It could be your pricing strategy. It could be moving into an adjacent industry. And that isn't as easy as it sounds. I think a lot of times people think our software is going to start in healthcare and then we're going to move to fintech. But really there's a lot of investment in the market facing side of the company to make that really happen. And so when you're resource constrained, it can be really difficult to peel off the bandwidth to do that. And so it is a real barrier to growth. And then kind of going back to where we started, a lot of people, there's this fundamental challenge that founding teams have of learning how to become a better team while integrating other people into it. It's like your DNA has replicated a lot. And if some of that DNA is like not the right DNA, it can be really hard to move people around. So maybe you had people that were in one job, but they're not really the right people to do it moving on. So moving people around, and it's messy and it can be really difficult and all difficult to do in a resource constrained environment where mistakes are scary and there's not enough money. It's just tough.
Right, that makes a lot of sense. Just basically kind of just making it easier to test new things.
That's important. Yeah, I mean, I'm biased because it's a big part of what we do, but but being able to experiment quickly in a resource responsible way so that the decisions you make are more data driven and science based, so that when you're making investments into market facing activity, they're not like just random thoughts, that you've actually done some testing and you've gone through some cycles to sort of prove that this is the right choice, can be really, really helpful in helping a company go further faster.
Awesome. I wanted to circle back on a lot of questioning that Vicky was going down. Like, we have a lot of underrepresented founders who watch inside the mind of an investor. And, question I have for you, because it sounds like you are more, if you will, unbounded in terms of what you are and how you're investing. What do you think are some ways that even some other investors or the investment community could get better with flowing more dollars to underrepresented founders? What do you think is some of the, the goodness that can happen there? How can it happen? If you just, and this is just, what maybe ideas that you may have or things that you may have heard, just trying to get it out there for folks to understand, some things that they may be able to do or things happening in the industry.
Well, I think one of the most important things we can do is broaden the toolkit. I think the foundational mistake is this idea that we're going to take, it's a lot of focus on a very narrow thread of venture as being the way to move the needle. The problem is when you pull back from that little needle, we don't thread most dudes through it. Like, most white dudes don't get through the eye of that needle because it's a very small eye of the needle and it's only appropriate for a relatively small group of companies. The idea that we change the game by just simply pushing more women and people of color through the same stupid needle hole, I think we should do that, by the way. There should be parity and equity over there. There's no reason for there not to be, and there are a lot of people doing that. But I think that there are so many other pathways to capital that people don't realize are out and being used, and we're not, if you're outside of these networks of privilege and you're not coming from these environments, you don't know how to access these other kinds of supports. And I do think one of the things that attracted to me, to be kind of a capital innovator was that, like I was the first person in my family to graduate college. I didn't know a lot about a lot of things. And if you don't know a lot about a lot of things, you have a sort of catch up thing that you got to do. But I found that for me, the way that I can make a meaningful impact at scale, individually, I make a meaningful impact by choosing very carefully who I advise, who I mentor, where I spend my time, what kind of stuff I do. But that's individual impact, right? At scale, by creating new capital tools and encouraging the creation of these toolkits well beyond mine, and some of the networks of people now that are using other ways of thinking about capital strategy, that's really changing things. Because then you can't use this excuse to block everybody. Like, it's really easy to look at a company that's run by anybody and say, you're not venture scale, so I'm not going to invest in you. And I can't just say I want to give you money because you're a woman if I still don't think you're going to be venture scale, and I'm going to burn money in a barrel, right? So having other ways to help companies move towards becoming venture scale. Again, for my model, we're more like TBD. But a lot of the companies that I invest into, it's not that they're not going on to be venture scale, it's that I don't need them to be. And sometimes after we've worked with them, they're better positioned to raise more venture, like, Series A, things like that. So I think broadening the financial toolkit, having more robust conversations about capital strategy, that's how we're going to really change the game. I think it'll be nice to look back and be like, wow, we moved from 4% of venture went to women to 5%. I don't, right? But what we want to say is that what we see now is new business creation is predominantly being driven by women and people of color. So I just think it's all about how you want to look at it. So I personally, I'm really biased towards capital innovation, coming up with novel capital tools to help just a more diverse array of founders, not even just about race and gender, but there's a whole generation of founders who want to have impact. And they want to have viable business models, but maybe viable business models that don't produce the venture scale outcomes that those investors want, but still produce a ton of really good stuff and wealth. Well, it turns out venture's not really good for that either. So I think there's a lot of opportunity in capital innovation to not just create more equity, but to create more good in the world as well. But one of the pieces of advice that I usually give a founder is to try to find a capital mentor. And that's not the same as finding an angel investor to have coffee with you and tell you how you should tell your story better, so you'll be more investable to an angel investor.
A capital mentor helps you decide what type of
a good capital mentor maybe built a company that's not totally dissimilar from yours, or worked in a company and has some familiarity with those tools. So here's the thing that probably we never tell most founders. So the reason why we don't train founders on capital education is the way it used to work is when you raised your Series A, your institutional investor would get rid of you and put their own people in place. They literally, when you take institutional dollars, you create a governance board. They usually bring in their own CFO. Sometimes they literally replace the entire leadership team. So historically, we didn't need to train founders about anything after equity because they'd be gone. And so even our favorite venture funded companies, you don't use equity for everything. That would be stupid. But we didn't need to teach capital education because those tools were sort of on that side of the fence. Well, it turns out the market has changed and a lot of those tools are on this side of the fence, but we're still not training founders how to think about that stuff. So you're seeing founders get caught up in predatory debt. There's all kinds of things that are it's good that different capital is out there, but in the wrong hands, you can misuse it. So we've really failed at capital education, and we failed at capital education because when I started equity investing, I didn't need to educate you about that. Because once you took that institutional money, you literally might not be CEO anymore, but you certainly weren't going to be the CFO, right? And now that's very much changed. And so there's a huge gap in the market for capital education. And I think that's another way to help founders who are outside these networks of privilege, because they're going to be the least likely to have the closest reach to that expertise.
When you invest, you said one of the things you talked about was, where do you add value? In addition to the growth piece of it, you talked about in your intro, your educational background and kind of your training, right? Do you only invest in those types of areas where you went to school for that? Or
no.
do you, okay.
No,
So
actually
how does that value piece and diversifying pain point piece play into with you? So
when I think about where I add value, it's not so much about where I like schools. I'm old. School was a long time ago.
Folks who invest in biotech or deep tech or, like that type of trade, or if they're a coder, and so because you, your model is so interesting, you kind of like, you approach it differently. I was just wondering.
I'll give you an example of like a company that I said no to recently because I didn't think we'd add value. This company's primary path to market is through government contracting. I could make an incremental difference by maybe helping strengthen your narrative. That's an inside game. Government contracting is an inside game. And that's all about understanding how to work those networks and those approved vendors. And so it wasn't a good fit for me. Like I couldn't make any impact beyond my dollars, like at all. Like sometimes, and just to be transparent, I don't want our help to be the reason you succeed or fail. That's too high risk. Like I want to invest into companies really in some ways that could win with or without me. I mean, the best companies don't need you, they want you, right? So when I think about adding value, it's not so much like, am I saving the day? Am I remediating you? Am I filling these critical gaps? It's just more like, can I amplify the impact of my cash investment with this capacity that we have and this with our growth platform and with our team? Do they fill a place in your plan where we can, for example, make a cash investment go further because you don't have to use those dollars to buy that expertise for some period of time? Or can we make those dollars go further because we can spare you the agony of putting it in places that we know from experience we can convince you that this is probably not going to work for you, right? Can I give you meaningful advice on your capital strategy? Like, can I look at your plan and do I have ideas for how you might access the right capital that you need? If you want to raise a round over here, can I help you build a venture story that's going to be interesting? So when I think about adding value, I am really conscious about trying to, like, it's not that I think I'm central or instrumental. It's more like I'm additive and I'm amplifying
it's less about,
the cash.
Am I a software developer? Am I a biology major?
For some investors, they're much more focused on, like if you are a biotech fund and you're focused on biotech investments, you're probably going to have an investment team that knows a lot about biotech, right? I invested in B2B and B2C companies across a pretty broad spectrum of industries, and over the last 140 companies, we've done a lot of stuff. So we're looking, we're not, because we're not hard tech or deep tech. I don't need to know your stuff better than you. I just have to know something about your ecosystem, about your operating plan, and about kind of your market that I can be additive along the way. Okay,
so that allows you to kind of dip your toes in kind of broader areas where you may not necessarily. Okay, so I see.
Yeah, I see. And I'm a generalist by disposition. So I've worked with hard tech, fintech, consumer products. Like my interests are sort of meta to that, right? So and then I have a partner, and he has slightly different interests. So it's not just me. It's more like maybe I'm not a perfect fit for this company as a partner, but my partner might be. So it's sort of trying to have the broadest sense of adding value without putting yourself into a position where the company can't succeed without you, because that's not, most investors don't want that. That's not a great position to be in.
Right. So as we're wrapping up, I just wanted to, I think it was touched upon, but so if it came down to, so if we take out the timing piece of it, which is interesting that you brought that up, because I actually don't hear that a lot, which I think we should hear more of it. But two sides of the debate. I understand it's a combination of different factors and it's always a balance. But if you had to choose one, what tips the scales for you, the horse or the jockey?
So I thought so you did me the favor of telling me about this question in advance. This question is a false binary, and venture rhetoric loves false binaries, and it uses false binaries to create a lot of rigidity around who is in and who is out. There is no successful company that doesn't have a little bit of both. If you have a wonderful product and a wonderful market and you don't have a qualified team, it's dead on arrival. I have seen wonderful teams who then just didn't have the right market or product or right timing, and they failed. The truth is, it is both. Yes, always team a little bit more, because you can improve product over time, but you can also improve team. Like, again, I think it's at its core, that came out of venture as a way to rationalize a lot of systemic bias. And I promise I will wrap up on this, but let me tell you what this means. People they say, I'm betting on the team because I know that they'll be able to adapt and persist. That's coded language often for teams that can just keep going because they have networks of privilege to support them for longer periods of time, meaning that they can go longer without success, go longer without getting paid. They can grind it out. It's used to say, well, they're genius, and that's why I bet on them. But honestly, it's been used, I think, in a really destructive way to obfuscate what teams really need to be successful. And so what it does is when a team then fails because they ran out of runway, it's because they were a bad team. No one ever does the work to find out, like, no, was it just that they couldn't live, couldn't be homeless anymore? Like, there's so much there that is very, like, unconsciously we talk about it without unpacking it. And if you look back where that language came from, we were talking about pretty privileged people coming from pretty privileged places with a lot of safety net. And yeah, of course you would bet into them because they would just keep going even if they ran out of money because someone else would keep funding them, right? So there's a lot there that has been used, I think, in a very destructive way. These false binaries have been used a lot to create kind of barriers to entry. And so I think the way to flip that around is if we agree that the team is the most important thing by some degree, well, what does it really mean to support a team? And what does it mean to support a team who comes from outside networks of privilege? And if you really believe that this is a team that can stick with it and grind it out and have grit, well, what do they need to do that? Because when you look at when these things fail to happen, oftentimes it's not because one team was less genius than the other. It's because somebody one of the founders had like a generous dad who kept paying the rent so they didn't feel like they needed to get day jobs and quit. Like, now, again, there are these outlier examples, particularly from Silicon Valley, of these incredibly genius people, like that you would just give them money no matter what they did. But the data doesn't even support that. The serial founders fail all the time. Like I just think I struggle with the question because one, it's a false binary. To build a good company, you need both. You need a really good team, you need a good product, and you need good market fit, and the timing has to be right, period. But I also, when I've lived in that, I've had that excuse used to defend some really biased perspectives on who's a good founder and who's not.
Well, I love that answer. I love that. I try to pin you in this corner, and you're like, I struggle with it. I just struggle with it because I struggle with it. That said, like, there's no company without people. There's no company without people. So I get it. I get the answer. But I think the older generation of people who said that, it was like a red herring for a bunch of other stuff that is not helpful to us today. So I think the question's less helpful today if we really want to make a difference. Like one of you asked me about how do we get more money to founders outside networks of privilege. We have to think a lot about long-term support systems. Like you can't fix it by putting more people into accelerators, but then having nothing for when they come out. Like you can't fix it by giving you one round. Like you're not going to fix it that way. We have to think about entire social support networks that have historically privileged one group of people over others to have an entrepreneurial success. And we've got to find ways to think about intervening all along that pipeline.
I feel like I've been pulled behind a curtain and I'm seeing things that I hadn't seen before. That was awesome insight you just provided, because you hear that now I'm going to rationalize as an excuse, all the time. Thank you for that. Thank you for that.
Oh, my pleasure. Yeah.
All right. Well, and that wraps up this episode of Inside the Mind of an Investor. Thank you so much, Melissa, for joining us.
Thank you. That was awesome. Really fun. Thank you for having me.